Hello everyone, I'm Raghav of Bits Hyderabad with the final report of my company, Sanofi India. Disclaimer: the values calculated are my own and I have no bearings or responsibility if they are wrong or misrepresents Sanofi India. Here is a brief overview of my company. Sanofi is a French multinational pharmaceutical company headquartered in Paris, France, and is a big player in the pharmaceutical industry. It has its subsidiary in India as Aventis Pharma with headquarters in Mumbai, India. It is involved in research and development, manufacturing and marketing a wide variety of drugs which deal in the area of oncology, cardiovascular, vaccines, etc. It is listed at the National Stock Exchange with the following ticker. Here are some of the key statistics. It is currently traded at Rs 2,346 with a 52-week high of 2,948 and a low of 2,075. It enjoys a huge market capitalization of 5,405 crores. It has over 23 million shares outstanding. Moving on to the analysis part, Sanofi India was thoroughly scrutinized and subjected to the following: fundamental analysis, ratio analysis, and valuation. In fundamental analysis, SWOT analysis and Porter's 5 analysis were performed on the company. According to the SWOT analysis, its strength lies in its early establishment, proper managing and working structure, and consistently delivering research and development wing. It offers wide range of drugs that covers almost all the major fields in pharma sector. Also, having strong financial resources allows it to have an aggressive acquisition strategy. Its weakness is its high dependency on successful patent protected drugs, for example Plavix and Allegra, that bring in majority of the revenue. Expiry of these patents could bring trouble or problems. Opportunities, like for every other company in this sector, is population growth, and this industry is never going to be in short of consumers. On to threats, legal issues can cost a real fortune and is interrelated to patency. And going by reforms taken by the government, company could face difficulties in the near future. On to Potter's 5 analysis now. The company has high threat of entry, high competitive rivalry, medium bargaining power of suppliers, medium bargaining power of buyers, and the competition from substitutes depends, as the drugs can be divided into two halves: the one patented drugs and the other generic drugs. Patented drugs have no threat of any sort, whereas generic drugs have lots of substitutes available in the market. Looking at ratio analysis now, the company has high liquidity ratios, low debt ratio, high turnover ratio, and increasing operating profit margin, which are positives for the company. Decreasing EBITDA margin and net profit margin are a cause of concern. By looking at the ratios, the present state of Sanofi India looks good. The strategy looks more inclined towards growing rapidly in near future, as current ratio and quick ratio determine. They have put in more money in the market now as compared to last year, with fixed asset remaining strong and with more current asset coming in. In short, by ratio analysis, Sanofi is a stable growing company. Valuation: the net present value of Sanofi India by FCFF model is Rs 9,896 crores. The company is growing at a stable growth rate of about 9%, which is good for a pharmaceutical company. Current market price is Rs 2,346 as on 28th October 2013. The intrinsic value of the share by FCFE model comes out to be Rs 4,289.84. Since the intrinsic value is more than the current market price, we can say the stock is undervalued, and hence I would recommend buy at current market price. By the dividend discount model (DDM), the true value of the share is calculated to be rupees 2541, which is higher than the current market price. Hence, a buy recommendation for this undervalued share. All the calculations have assumed a good amount of shares being traded, whereas the volume of this share is under 1000, which is not great. Ratios of the company show that it is very liquid and can remain solvent in case of emergency. On comparing ratios with its competitors, Sanofi is performing better than most of the companies in the sector, but is lagging behind majors like Sun Pharma and Ranbaxy. 23 million shares outstanding means lower earnings per share and lower demand. That's all from Sanofi India. Thank you.